Hey guys, this is Eric with Eric and Nikki, and today we're going to take a look at Graham Stephan's predictions for the crash of 2021. When is it going to crash? I don't know. I haven't ever watched this video, so I'm going to give you our perspective. We did a video recently of what's the impeding crash of the market and what does that look like. Find it here. As always, smash that like button, hit that subscribe button, and tell your friends. So let's dive in.
Record low, and buyers are left paying significantly over asking just for a chance to get the home they want. However, it's kind of strange because during the same time as all of that, 2.6 million homeowners are still in forbearance, up to 20 million tenants are still behind in their rent, and the biggest wild card from all of this is that interest rates are now beginning to go up. Now here's the thing, throughout the entire history there's
all right, so let me start there. Basically, 100% on with that. So the houses are rising, the stock market is rising, the boom of the interest rates are starting to climb as millions of people are still in forbearance. So right on with that. So let's keep going.
Always been a boom and bust cycle of the real estate market, and at some point in the future there's going to be another real estate crash. Now, even though we don't know exactly when and what will cause it, there are some lessons that we could use from previous real estate downturns that anyone could apply today. So let's talk about exactly what's going on right now, the chance of another crash happening sometime soon, how bad it would be if it were to happen, and then precisely what you could do about it to make sure you don't lose money and instead to make sure you make money. Because that's what this channel is all about, as with getting your 2 free stocks down below in the description. But really quick, before we talk about that, I gotta share a quick message from my cat Ramsey.
Hey guys, I'll just make this super quick. I told Graham he needs to give me a treat if this video gets 69,000 likes, and I really want a treat. So make sure to crash that like button for the YouTube algorithm so I can stop trying to sneak into the treat bag late at night when everyone is sleeping. Thanks so much, and now let's get back to the video.
All right, so that is hilarious.
Out how to best prepare for something like this, it's really important to understand the severity of the real estate crashes that have happened in the past. Because even though it's easy to think that you could lose everything if the market goes down and you're underwater on your loan and then the bank forecloses on you, chances are most market crashes are not as catastrophic as you might think. Like, one of the first major real estate crashes happened in the year of, you guessed it, 1929. Just like the stock market peaked from record high speculation and borrowed money, the real estate market fell alongside everything else. Real estate values plummeted by nearly 67%, and it took nearly 3 decades for real estate values to recover back to their pre-crash levels.
So I had no idea that the real estate market went down in the Great Depression. 67% drop. Unbelievable.
Then again, real estate encountered more difficulty in the 1990s. Until then, the real estate market was seeing a huge increase from new lending options, inflation, and a growing population. But the savings and loan crisis caused interest rates to go up, new constructions ended up going down, and prices remained fairly flat until about 1997. And now, the most recent crash that almost all of us should remember is the housing collapse of 2008. This is caused by too many people speculating on the value of real estate, fueled by easy access to money and adjustable rate mortgages that allowed anyone to buy a home as long as they could just...
I don't know that it was fueled by that as much as it was fueled by fraud. The 2008 crisis was fueled by pure fraud. The mortgage industry fraudulently packaged loans together and sold them off as good loans to banks. That is called fraud. And that is why it got hit so hard and heavy. Not necessarily just because banks gave everybody money, but they were giving anybody with a pulse money,
as long as they could just make the introductory payments. However, a lot of those mortgages had a sudden balloon payments built in, which would cause the price of that mortgage to skyrocket after a...
I still do a bunch of balloon payments. They still happen today. I make great money off of them.
Few years, and as we all know, that turned out to be a disaster. But as more homeowners began defaulting on their payments when they weren't able to sell, that then fell back on the bank, who wasn't able to pay the investors who bought the loans to begin with, and that caused a near financial collapse. Depending on the location, housing prices dropped anywhere from 30 to 62%, a new bailout was put in place, but now, again, in 2021, we are back at another record all-time high. However, the interesting part throughout all of this is that with the exception of 1929 and 2008, for the most part, the prices of housing have been fairly resilient. Like during and after World War II in the 1940s, the price of real estate ended up booming from a surge of demand. Then during the 1970s stagflation era, where the stock market went down, real estate prices ended up going up because of inflation. After that, during the 1980s recession, real estate went up in price 4.5% because inflation was still high. The 1990s certainly saw some real estate markets going down in value, but for the most part, that was limited to no more than about 10%. The dot-com bubble also had very little effect on real estate values as interest rates continued going down. In fact, in 2001, home prices climbed to, at the time, an all-time high.
So this is a good point that I would like to make as he's saying all this. Real estate has been steady, except for two major times, 1929 and 2008. Real estate has pretty much been steady across the board as going up. So what are you putting your money in?
Little effect on real estate values as interest rates continued going down. In fact, in 2001, home prices climbed to, at the time, an all-time high. But now we have some different challenges that will directly impact the real estate market. And when it comes to the issues that might happen today, we have three obstacles to overcome. The first is that right now, 2.6 million homeowners are in mortgage forbearance, meaning they've temporarily paused their mortgage payments until the illness subsides. The concern right now is that if those 2.6 million homeowners are unable to make their mortgage payments once the forbearance period is up, they risk going into foreclosure, and if that happens, there could be
So a little bit more about forbearance. So right now in forbearance, they're talking about it right now. They're talking about extending people's loans from 30 to 40 years to cover forbearance. Even though forbearance has a lot of people out there, I really think the government right now is going to do everything they can to keep that very, very low. So let's keep going and see what he says about it.
Could be a wave of foreclosures all coming on the market at the exact same time. The other belief is that homeowners might postpone listing their homes on the market while they're not making their payments, thereby further restricting the available supply of housing on the market.
That is definitely happening right now.
The good news is that, at least as of right now, the mortgage forbearance rate has been steadily decreasing month over month, which suggests that many homeowners just took mortgage forbearance out of an abundance for caution, because why not? And now as the economy is beginning to recover, they're starting to make their payments again. The new stimulus plan would also extend mortgage forbearance and foreclosures through June. So even though it might be the equivalent of just kicking the can a little bit further down the road, it does give people more time to financially recover and get back on their feet. Now, the second concern has to do with the 20 million tenants at risk of eviction. However, I just gotta call this one out for what it is, and that would be false. I looked into this one further, and they got that data just from a survey that asked people how confident they were that they would be.
So I'm going to tell you, I 100% agree with the false information there. So I own about 200 units right now, and I have two people that aren't paying. And the only reason they weren't paying is they weren't paying before COVID, and they're not paying now. And I'm working on getting them out. The only reason I can't get them out is the forbearance, but everybody else is paying on time. So I definitely don't see that as an issue going forward.
Be able to make the payment next month. And in that survey, they estimated that 14.2 million households don't have 100% confidence that they could pay their rent next month, and that translates into over 20 million renters. But even though that makes a great headline, that's not entirely factual. And just because you don't have 100% confidence you can make your rent payment doesn't mean you're not still going to make your rent payment. In fact, if we go and use actual data from the National Multifamily Housing Council, go and say that 5 times, we could see that over 93% of tenants are still paying their rent in full by the end of each month.
93%, that's kind of what I'm saying in my own portfolio, is about 93% are paying.
Tenants who are behind on their rent are a legitimate concern. And when it comes to that, the average delinquent renter is nearly 4 months behind on their payment. They owe $5,600, and in total, $57 billion.
Interest rates increasing.
Home prices to come down. Like I said, at some point in the future, the housing market is going to be going down, and it's extremely important that you're prepared for this, so that way you can do your best to make sure you don't lose any money. Now, the first thing that I would recommend that everybody do is get a 30-year mortgage. Now, I know what most people would think when they hear this.
I do not recommend getting a 30-year mortgage. I think getting a 30-year mortgage is what keeps people down. A lot of people don't know this, but a 30-year mortgage, when you get a loan or you refinance, banks make you pay most of the interest rate within the interest in the first 5 years. Because you have to pay the most interest in the first 5 years, if you take 5 years and then refi 5 years later, you actually restart your interest and you're paying more interest. So you're paying your principal balance down tremendously. I do not recommend a traditional mortgage. Look into something that's called a first position HELOC. It's where you can pay interest only and reduce the balance, and replace your mortgage is a good option. We can attach them at the bottom, but I do not recommend a 30-year mortgage moving forward. Now, if you're just wanting to be safe, you're never gonna really do investing in real estate, you don't care about making more money, you don't care about losing money, definitely get that 30-year loan.
But Graham, you pay more interest on a 30-year mortgage than a 15-year mortgage. Why would you cost us more money? Why would you mislead us like this, Graham? Dislike and sub.
And yeah, on the surface, it does look like you're going to be paying more interest on a 30-year mortgage, but in reality, that's actually going to help you save more money. That is because the 30-year interest rates are at the lowest point they've ever been in history. And when you consider that your investment returns are probably going to be way higher than what you pay in interest on a mortgage, it starts making a lot of sense not to pay off your mortgage early.
Side note, I don't recommend a 15 either. If you're gonna choose between a 15 and a 30, go with a 30. But I definitely recommend alternative investing strategies for your primary residence.
And instead, invest the difference. Not to mention, inflation makes your mortgage easier to pay off with future dollars. So actually, the longer you keep it, the cheaper and easier it becomes to pay off. But the 30-year mortgage also gives you a huge advantage over any other option out there, and that would be flexibility. Listen, there's nothing stopping you from paying off a 30-year mortgage in 15 years. Just make a higher payment every month and boom, it's the same thing. But if something comes up and you need to pay less, a 30-year mortgage gives you more flexibility to make the minimum payment and then save the...
That's also what a HELOC, a first position HELOC, allows you to do. So it allows you to get a really, really cheap monthly payment. And if you want to pay it off sooner, that's what allows you to do. So exactly what he's talking about on a 30-year mortgage, except for you save the interest.
Difference instead. That's why I always recommend locking yourself into a 30-year mortgage, because during a downturn, you have a choice to pay a lower amount than if you had locked yourself into a 15-year mortgage. The second, speaking of all of that, always make sure you get a fixed interest rate. Right now, with interest rates so low, it makes sense you lock in a fixed payment so that way your payment stays exactly the same the entire time. By doing this, you're going to know with 100% certainty what your mortgage payment is.
I don't get fixed interest rates. And that may be something that's a risk tolerance thing, but I love my HELOC. There's two different options. You can do what's called a LIBOR, or you can do the regular rate, and it's prime plus 2. But I really think that if your goal is to either have money to invest, or if you just want the security of having a primary residence, you know, then yes, a fixed interest rate 30-year loan is definitely where you want to be. But remember, 99% of people are doing it that way. Do you want to be the 1% or you want to be the 99?
Fixed payment so that way your payment stays exactly the same the entire time. By doing this, you're going to know with 100% certainty what your mortgage payment is going to be over the next 30 years, and by doing so, you can plan accordingly. This prevents your payments from suddenly being increased 5 to 7 years from now if interest rates are higher in the future as they are today, which they probably will be.
Do you know what the average person keeps their home for right now? Let's look that up. So I think the average person keeps their home about 5 years right now. So what he's talking about is within a 5 year, they have what's called a 5-1 ARM, 7-1 ARM, and 10-1 ARM. An ARM is an adjustable rate mortgage after the first 5 years. You know, if you end up hitting that balloon payment on the refi, then, but what a lot of people don't tell you about an ARM is an ARM can only go up 1% per year, and it can also go down as well. So again, that may not be the best option, but I definitely recommend alternative financing.
And if that were to happen at the same time the real estate market falls down, not only is that going to be costing you more money, but the market value of that home is going to be falling alongside with it. That's why you should just go ahead and lock in your interest rate, and then no matter what happens, your payment is going to be staying the exact same until it's entirely paid off. Now third, you could also refinance your home to save more money. Most likely, if you own a home already, you've either looked into this or you've done it. But if you haven't and you have the opportunity to refinance,
I definitely recommend refinancing your home if you have a lot of equity in it, but I don't recommend refinancing for 1/4 of a rate or 0.5% of a rate or anything like that, unless you're gonna go into an alternative form of financing. But if you have a lot of equity and you can pull that equity out and put it into different things, it's a good option.
Finance your home and save more money, then do it. Doing this allows you to get a brand new loan that replaces your current loan, and most likely the new loan is going to be at a substantially lower interest rate than what you're currently paying, thereby saving you more money in the process. Like for myself in the last year, I've been able to refinance 2 of my mortgages, saving me about $1,000 a month from maybe about a day's worth of work. And also in doing so, I was able to lock in my interest rate for the next 30 years. Doing that makes your payments that much more affordable in the event the market goes down, or you lose your job, or something else happens that would affect your ability to repay back that mortgage. Now fourth, this is a really important one, but avoid selling your house if you don't need to. The truth is, real estate values only matter if you intend on selling.
100% agree with that. If you can avoid selling, wealth is created on the hold, not on the sell.
So everything I've mentioned so far is really just designed to make your payments as low and predictable as possible so you won't need to sell. And ideally, by not selling, you'll have the time to ride out any short-term fluctuations in the price until eventually things recover. The fifth, always make sure to keep an emergency fund on the sidelines just in case you need it. The reality is, with real estate, anything could come up at any time that will end up costing you money. Like for example, you might go an entire year without anything going wrong, and then one morning, you'll wake up and it's $2,300 to fix an HVAC unit. That just happened to me in a rental unit. The truth is, with real estate, you're still going to have a fixed
That's a cheap HVAC unit.
cost every single month with owning a property, like property taxes and insurance that needs to be paid. So my recommendation is to always keep a few months worth of your property's expenses saved up in cash on the sidelines at all times. So that way, should something come up, you're always going to have the money to pay for it.
So I definitely recommend keeping some money aside as well, but not necessarily in just a savings account. Probably put it in, I say this, but Bitcoin, different alternative financing options, because with inflation right now and what's going on with the dollar's going down. So if you put 30 grand in a bank account that's giving you 0.001 interest, you're actually losing money by having that money in there.
And six, if you haven't done this already, it's incredibly important to get your 2 free stocks down below in the description, because Webull is going to be giving you 2 free stocks when you deposit $100 on the platform, and those stocks could be worth.
Maybe I should go get my 2 free stocks.
But anyway, for real, number 6 is to only buy a home that you know you could comfortably afford. Don't bite off more than you could chew. Don't overextend yourself because the house is awesome. And instead, get something that's not going to cost you more than what you could reasonably afford. Generally, I recommend your housing payment not exceed 25% of your income, and maybe on the high end, 33%. The lower your payment is in
Definitely agree with that as your primary residence. Stay below what you can assumably afford for sure.
In relation to how much money you make, the safer it's going to be in the event of a downturn and something happens to your income. Real estate should ideally be something you only buy if you have the intention of holding on to it for at least 8 to 10 years.
So that was the key. Did you hear that? He said real estate is only going to be good if you buy it and hold it between 8 to 10 years. A lot of people don't do that, so they don't get to create the value. So remember that. Holding real estate is where you make your money.
Appreciate the resiliency of the real estate market throughout history in terms of being a fairly stable store of value. Now, that's not to say that prices will not go down, because certainly there will be times where everything slows down and values drop. But instead, it's a lot more important to make sure that you buy a home that you can afford, that you lock in an interest rate for as long as you can. You ideally get that mortgage for 30 years, and then from there you just hang on to it for as long as you can. I highly doubt we would see a crash as severe as 1929 or 2008, which were both events that were highly concentrated and directly hit the real estate market. And really instead, I wouldn't be surprised if we just saw a gradual slowdown in prices over time. Even though increasing home prices are beginning to worry people, as long as you buy a home that you could afford. With the intention of holding it 8 to 10 years, you should be fine, and that should be long enough to ride through any short-term fluctuations in price. And really most importantly from all of this, the best thing that you could do is make sure to smash the like button for the YouTube algorithm.
He has a ton of good points. He doesn't really talk about, is it going to happen anytime soon? So as far as the real estate crash coming, lumber's up, house prices are up, inventory's down, the market demand is crazy right now, and I agree with him. I don't really see a crash coming that's going to just drop out of the bottom like 2008 did, but a gradually down. So is he the real deal? I agree with almost everything he said. I think he definitely knows what he's doing, knows what he's talking about. Love watching his YouTubes. Very, very much enjoyed this video and what he had to say. As always, as Graham says, hit that like button for that YouTube algorithm.
make sure to crash that like button for the YouTube algorithm so I can stop trying to sneak into the treat bag late at night when everyone is sleeping.
Smash it, keep going, and hit the subscribe button. Thanks, guys.